Good morning, everyone. Good morning. Zoom people, can you hear me? Okay. There was some technical difficulty, so it is sorted now. Let's start. So, yesterday we had completed the discussion to which module? We were discussing on IRPT, PPPT, everything done, no? IRPT, PPPT done. So, now only one concept is left, and then there are miscellaneous questions. So in today's lecture, we will be covering that one concept and the miscellaneous questions. And then Forex will go on a pause because from tomorrow, we will be starting new chapter for South India batch. Okay. One lecture will be pending of Forex. You know that one case is left because I think Mumbai students are going for something else, audit or something is starting. I don't know what is starting, but one lecture will be left that we will do it in a future date. Okay, but South India batch will continue with me, and we will continue with FM. All right. So in the notebooks, please give heading module number what now? 15. Module number 15, and give heading miscellaneous questions. Module 15, give heading miscellaneous questions. Module 15, miscellaneous. Hey, I'm so sorry. I told miscellaneous questions. One module is left. Anyways, we'll do this first. No problem. Whatever God desires. Miscellaneous questions. Okay. It's okay. Module 15, miscellaneous questions. So come to question number 56. Come to question number 56. Yes. Please come to question 56. Read it carefully, please. Okay, so this is a slightly complicated question. I see AI. All the best. Let's understand. Omega Electronics exports air conditioners to Germany by importing all the components from Singapore. Okay, so this is this company from India called Omega Electronics. It buys components, raw materials from Singapore and sells it to Germany. Everybody clear? Sells it to customers in Germany. the company is exporting 2,400 ACs at a price of euro 500 per unit. So the selling price for Indian company is 500 euro per unit, and the buying price of the components is Singapore dollar 800 per unit. Everybody clear? Raw material cost is SGD 800, selling price of FG is 500 euro. The fixed cost and other variable cost per unit are 1,000 and 1,500 respectively. This is considering that the manufacturing is happening in India. The costs are given in rupees, 1,000 and 1,500 are variable and fixed cost. The cash flow in foreign currency is due in 6 months. Oh, that means even to Singapore supplier and also my European customer, German customer, cash flow will happen after 6 months, meaning I have to pay Singapore dollar in 6 months. I have got 6 months credit. I will receive euro 500 also after 6 months only. Everyone following? Okay. The current exchange rates are as follows. Now they have given to you the spot rates, and then they are saying after 6 months the exchange rates turn out to be as follows. So this is spot rate after 6 months. Everyone clear? So they are now asking you, you are required to calculate loss or gain due to transaction exposure. Now, transaction exposure is another word for currency risk. Okay. Currency risk and transaction exposure are the same thing. So now what does ICAI mean by asking you this question? Let us try to understand. See, do you all agree that these rates given to you, spot rates today, are useless for the question? They are useless because they are today's spot rates. You will be getting the currency after 6 months, correct? But I will first of all want you to, as a part one of point A, let us calculate what we would have got if these rates would have not fluctuated. Are you able to understand? If these rates would, can you see they have actually fluctuated, no, after 6 months. I am saying that if they would have remained stable, how much you would have got. Now, do you realize that profit or loss that you would have got is notional cash flow? Because reality, do you realize, is based on these cash flows? See, ideally, do you realize they should have taken a forward cover for 6 months, but there is no forward cover given in the question. They are straight away going to the spot rate after 6 months. Everyone clear, no? So they are saying that after 6 months, no, whatever the spot rate will be, we will accordingly take the deal. So here they are not hedging their foreign exchange risk. I am saying, okay, they are not hedging, and therefore the spot rates after 6 months will be applicable to them. So the actual cash flow that they will be getting, do you all realize, will be on the basis of these second set of exchange rates? These exchange rates are useless, but I am asking you to first calculate what would have been the cash flow if these exchange rates would have prevailed. Everybody, are you understanding? And let's say that the profit that you would have got if these exchange rates would have not fluctuated is rupees 100. Just giving random number, is rupees 100. Now this profit, do you realize, is notional profit? Actual profit, do you realize, will be based on these rates, the down rates? And let's say the actual profit that we are getting is rupees 90. So then what we will say? We will say, oh, because the currency exchange rates fluctuated, the loss I suffered due to currency risk is rupees 10. Understood the question? The loss I suffered due to currency risk is rupees 10. Because if currency risk was not there, if currency exchange rates wouldn't have fluctuated, I would have got 100. But because of the fluctuations in currency exchange rates, I lost 10 rupees. That is why I'll say my loss is 10. Everyone clear? If I would have got 190, then I'll say, oh, because of currency fluctuations, I gained 90 rupees. Everyone clear? That is the whole story. So, okay, I'll remove all this and let's start writing. Write down question number 56. Question number 56. Point number A in that part 1. Calculation of notional rupee cash flow based on today's spot rates. Calculation of notional rupee cash flow based on today's spot rates. Again, why am I using the word notional? Because this is not actual, correct? So what are the spot rates given to you? 1 euro equal to rupees 51.5, 51.55. Write down spot rates. 1 euro equal to rupees 51.5, 51.55. And second, 1 SGD equal to rupees 27.2, 27.25. 1 SGD is equal to rupees 27.2, 27.25. Done. Now identify between these which is the bid rate and which is the ask rate, or what should I take. Now as far as euro is concerned, can I say we will be receiving euro from our customer. We will take that euro and sell to the bank to convert to rupees. Bank will buy euro from us. Do you realize for euro the relevant rate is the bid rate? Everyone clear? Now regarding Singapore dollar, can I say I have to pay Singapore dollar to my supplier, for which I have to buy Singapore dollar. If I for buying Singapore dollar, can I say bank will sell Singapore dollar, and the relevant rate, can I say, will be the ask rate of SGD. Everyone clear? So write down for euro receivable, relevant rate to convert to rupees will be BR of euro. That is 1 euro equal to rupees 51.5. Full stop. For SGD payable, relevant rate will be AR of SGD. That is 1 SGD equal to rupees 27.25. Now stop and see what I'm doing. I am writing notional rupee profit. Wait, will be. Now I want you to pay attention. First of all, do you realize we will be selling 2,400 ACs? Everyone clear? We will be selling 2,400 ACs. Each AC I am going to be selling for euro 500. Do you agree? Each AC I'll be selling for euro 500. Each euro will be converted to rupees at 51.5. Do you agree? 51.5. Done. Now, if I block this, do you realize what you get in front of your screens is the sales in rupees? Everyone clear? Now, what I will do is I will put a bracket like this. Okay. I don't need the sales. I need the profit. Now for profit, can I say I will also have to calculate the cost. The cost, do you realize, is Singapore dollar 800, for which, can I say, I'll have to pay 27.25 rupees per SGD. Everyone clear? Hello? So, hello, everyone following? No? Zoom people clear? Okay. So 2,400 units into euro 500 into 51.5, that is selling price. This is, can I say, selling price per unit in rupees. This is purchase price per unit in rupees. Everyone clear? Apart from this, there are two more costs. Do you realize there is a 1,000 rupee variable cost? There is a 1,500 rupee fixed cost. Students, are you all able to understand what I have done here? साक्षी नहीं समझ रहे ना, लेट आई क्या? अच्छा ठीक है. So those who came in late, forget this question. But you're understanding now, okay. But you're listening now then, okay. So now, before you start calculating, you are understanding what is happening. There is a selling price, there is a purchase price, and there are two manufacturing costs. So basically, these three costs are there. This is the selling price. This entire square bracket, can I say, is the profit per unit in rupees. And then I'm multiplying by number of units. Zoom people clear? Sure. Okay. Please tell me how much is the profit in rupees? 34 lakh 80,000. Okay. It is rupees 34 lakh 80,000. Anyone who was there from start wants me to re-explain anything? All clear? So how many costs are there? Three costs: purchase price, variable cost, fixed cost. Variable cost, fixed cost need not be converted into anything because it is already given to you in rupees. Purchase price was given to you in SGD, that I converted to rupees. And for profit, I also need to take sales. Sales was given to us in euro. I converted that to rupees. Correct? The entire square bracket is in rupees, but on per unit basis. And then I multiply by number of units. I will get total profit. Now, this profit that you see on the screen, Usuma, clear, no? Okay, this profit that you see on the screen, is it actual or notional? Notional. This is not what I actually got. This is what I would have got if currency exchange rates wouldn't have fluctuated. Everyone clear? Hello? So now what I will do, I will say part 2. Okay. Now part 2, you please give me the numbers. Part 2. Now what do you think part 2 will be? Part 2 is basically, okay, what will be your actual rupee inflow? Correct? What will be your actual rupee inflow? So here I will write part 2. Wait, calculation of actual rupee cash flow based on spot rates after how many months? 6 months. So spot rates after 6 months. Give me the numbers. 1 euro equal to how much? 51.7580. Okay, you have to take these numbers. Okay. These numbers, correct? Okay, we'll do it again. So this is 51. Okay, tell me how much it is. 50? 52.00. Okay. 52.05. Next. 27.7. 27.75. Now, Krishna, not. Now, for the euro receivable, relevant rate to convert will be same now. Now also it will be bid rate only, but the bid rate has changed to 52. Correct? The bid rate has changed to rupees 52. For the SGD payable, the ask rate of SGD has changed to rupees 27.75. Everyone clear? So the only change will be, instead of 51.5, we will be taking 52. Instead of 27.25, we will be taking 27.75. Now please tell me, what is your actual rupee inflow? $31,20,000. Anyone else got this number? Please check. Correct? 31,20,000. Done. So now you please tell me, because of fluctuation, are you losing something or gaining something? Can I say, if fluctuations wouldn't have happened, you would have got 34,80,000. Because of fluctuation, you're getting only 31,20,000. Do you realize, therefore, loss due to transaction exposure? Transaction exposure means currency fluctuation risk. Hmm? Do you realize will be 34 lakh 80,000 minus 3 lakh, I'm sorry, minus 31 lakh 20,000, and that is rupees 3 lakh 60,000. Full story clear? Everyone following? Okay, quickly copy this. Point number A is done. Point number A. मोनिका ये हो गया. This is done. हम्म, हाँ हाँ. All done? Done? Zoom people done? Okay. So this was the heading. So now everyone read point number B. Everyone please read point number B. So slightly tricky point. Please read carefully. Okay. So they are saying based on the following additional information, calculate the loss or gain due to transaction exposure. Forget these words operating exposure. I will talk about it in some time. Right now, can you see the question is replica of question point number A. They are again asking, show the loss or gain due to transaction exposure. Same to same they are asking. But now they are changing little bit data. Are you all ready? They are changing little bit data. They are saying if the contracted price of the AC is 25,000 rupees instead of 500 euro per unit. Are you all able to understand? They are saying now don't make the bill in euros. They are saying make the bill in rupees only. Everyone clear? So the rupee selling price is rupees 25,000. Everyone following? SGD is not changing. That will remain. Purchase price is still 800 SGD. Selling price instead of 500 euro, you are fixing it at rupees 25,000. Now, second thing they are changing is current spot rate. Hold on. Current spot rate means, do you realize instead of these numbers, got it? They are telling you that the revised spot rates are like this. They have changed to like this. Everyone ready? Which means the spot rate after 6 months is not going to change. Everyone listening, the spot rate after 6 months is not going to change in the question. Only the current spot rate is changing. Is anyone understanding? Hello? Okay. Zoom people, please switch on your videos. I'm struggling to teach. People are not there only. Thank you. Okay. So now what should we do? We have to recalculate everything again. Are you listening? We have to recalculate everything again with these two changes. Which two changes? One change is selling price. Second change is spot rate. Everyone ready? Okay, so don't write anything now because there is a long explanation pending. So wait. By the way, this was part 2 of point A only. And now I am writing point number B. Please listen very carefully. So I am going to again copy this. Don't write, there is a request. Please don't write. You have to understand many things pending here. So I will write here point number B. Okay. And here I'll write part 1, calculation of notional rupee cash flow based on today's revised spot rates. Are you all there? Based on today's revised spot rates. Okay, now please tell me revised spot rates. 1 euro equal to rupees how much please? 51.75. 51.80. 1 SGD equal to please today's spot rates. How much? 27. Okay. 27.10. 27.15. Now look at the screen. Do you realize that for euro receivable, relevant rate to convert to rupees will be bid rate of euro, that is blah blah blah, is all going to become irrelevant now. The reason is that there is no euro in your life now. Are you able to understand? You are directly putting the bill in rupees only. So do you understand that this entire thing goes out? Everyone clear? No, this entire thing goes out, and straight away what starts is for SGD. Everyone clear? No, what starts is for SGD. So I'll just write here for SGD payable. Everyone clear? For SGD payable, relevant rate will be AR of SGD. That is 1 SGD is equal to rupees 27.15. Everyone clear with this? Everyone following? Hello? Sure? Okay. So now tell me, how will things change in the notional profit? 2,400 will remain 2,400 only. But this entire thing will go out. And can I say, instead of that, I will straight away say rupees 25,000. Everyone clear now? I'll straight away say rupees 25,000. Selling price per unit is rupees 25,000. Following, no, everyone? Purchase price, can I say, will be SGD 800 multiplied by rupees 27.15. And do you realize 1,000 and 1,500 is not changing? Hello, all clear? So please give me the notional profit now. 18,72,000. Everybody got this? 18,72,000. Please check. 18,72,000. All done? This is part 1. Can I say there will have to be a part 2 also? Hey, can I say part 2 will be on the basis of which rates? Spot rates after 6 months, which is not changing. Now you might feel, sir, if spot rates are not changing, that same answer will come. No, because your selling price is changing. No, you are not taking euros now, you're taking rupees directly. So what I will do is, I will now take this and I will place it here. I will say part 2. Okay, part 2. Calculation of actual rupee cash flow based on spot rates after 6 months. Spot rates after 6 months. Give me the rates again. 1 euro equal to 52.0005. SGD 27.7. 27.75. Can I say for SGD payable, relevant rate will be AR of SGD, that is 1 SGD equal to rupees 27.75. Everyone clear? 27.75. Then I will say the actual rupee profit. The actual rupee profit. Tell me, where are things going to change now? Only the SGD rate is changing. Everything else is same only. So instead of 27.15, we will take 27.75. And this comes to a final profit of 7,20,000. My God, what a drop. We were expecting a notional profit of how much? 18,72,000. Everyone clear now? 18,72,000. But because of the currency exchange rate fluctuations, you are ending up getting only 7,20,000. Therefore, loss due to transaction exposure, loss due to transaction exposure will be 18,72,000 minus 7,20,000, and that comes to 11,52,000. Everyone clear till here? 11,52,000. Done. So can I say point A and point B? Point A and point B are basically same calculations with different rates. That's it. Everyone clear? Same calculations with different rates, and point B is having different selling price also. Everything else is same. Story clear till here? Okay. Now let us talk about what is this thing what they mean by operating exposure. Now to explain this to you, operating exposure means now they are asking you what is your effect on gain or loss, or how much are you gaining or losing, not only due to currency fluctuations but also due to business reasons. I'll tell you everything, don't worry. So for that, now first of all, read point number 2. They are saying something called as price elasticity of demand is estimated to be 1.5. Price elasticity of demand is estimated at 1.5. Now we have to go a little deep here. Please pay attention. Everyone, please become Germans. You are importing ACs from a foreign country called India. Come on, everyone. You are importing ACs from a foreign country called India, and that country called India is making you pay 25,000 rupees. Are you able to understand that country is making you pay 25,000 rupees? Hello? Is this rupees home currency for you or foreign currency for you? Foreign currency for you. Everybody clear? This is a foreign currency for you. Sure, clear, everyone follow until here? Okay. Now, I will take you back to these spot rates. Listen carefully. I will take you to these spot rates. Students, in these spot rates, I'll first of all in the notebook write down part 3. Okay. And I'll write calculation of actual rupee cash flow considering something called as operating exposure. Okay. Now, for the German, can I say purchase price is rupees 25,000 per unit? And this, do you realize, for the German is a foreign currency? Come on, everyone. Now, what are our original spot rates? Okay, what are our original spot rates? Original spot rates is 1 euro equal to rupees 51.5, 51.55. Everyone ready? 51.5, 51.55. So I'm writing here rupees 51.5, 51.55. Now, I want to calculate what is the purchase price for German in terms of euros. Are you able to understand in terms of euros? So I'll write here calculation of purchase price for the German in euros. Now just think, do you realize as a German, there is a foreign currency payable, correct? There is a foreign currency payable of rupees 25,000. That German will go to his or her bank to buy euros. So can I say German wants to buy, I'm sorry, not euros. German wants to buy rupees, correct? Bank will therefore sell rupees. Everyone awake? Bank will therefore sell rupees. Bank will sell rupees at the AR of rupees. That is 1 rupee equal to euro 1 upon 51.50. Come on, everyone. 1 euro equal to 1 rupee equal to euro 1 upon 51.50. Therefore, to buy rupees 25,000, can I say German has to pay 25,000 into 1 upon 51.5, and that comes to euro 485.44. Everyone clear? Do you realize this is his or her actual purchase price in terms of euros? Everyone clear? In terms of euros, actual purchase in today's terms, purchase price is 485.44 euros. Any doubts? No. Now, current spot rates change as follows. Okay, current spot rates change as follows. Now, what do I mean by this? Current spot rates change. Where did current spot, which I'm not going to after 6 months, I'm talking today only. In today's terms, can I say this spot rate, which was 51.5, 51.55, can I say now became this? Come on, everyone. It became 51.75, 51.80. And it is all happening today only. Everyone clear? Today only. I hope you're getting it. Now, current spot rates changed. So it became 51.75, 51.8. So I'm writing here 1 euro equal to rupees 51.75, 51.8. Can I say therefore to buy rupees 25,000, German has to pay 25,000 into 1 upon 51.75. Can you tell me he has to actually pay how much euros now? 483.09. Now, therefore, do you realize that because the spot rates changed, the ACs became cheap for the German? Take your time and understand what I'm trying to say. Because the spot rates changed, see, the purchase price still is 25,000 rupees only. But from euro point of view, from his home currency point of view, can I say it has become cheap? Come on. Everyone clear? Therefore, purchase price for German has dropped by, now, what was his original purchase price? Euro 485.44. From there, it dropped to 483.09. Students, see what I'm doing? Divide by 485.44. That is the original purchase price into 100. Can you tell me his purchase price is dropping by how much percent? 0.48%. Everyone getting it? 0.48%. Hello. Now you might think, why am I doing all this? Oh, we are doing it because of a concept called as price elasticity of demand. Hello. Now, what do you mean by price elasticity of demand? They are saying that the price elasticity of demand is 1.5, which means if the price drops by 1%, demand will increase by 1.5%. Are you all able to understand? If the price and demand go in inverse relation, no, I hope you understand economics that much. Price drops, demand rises. Price rises, demand drops. The rate in which they are dropping and rising, the rate at which demand will react to a change in price is called as price elasticity of demand. Everyone clear? So here, do you realize, Tanisha, clear, no? So here, do you realize that 0.48% is the drop in price? So I will say, therefore, considering 1.5 times price elasticity of demand, do you realize demand will increase by 0.48 into 1.5, that is 0.72%. Are you able to understand? Whatever the price drops, demand will increase 1.5 times. Story clear? Demand will increase 1.5 times. Any doubts, please? Demand will increase 1.5. Can I say therefore revised units that the German will buy will be 2,400 units plus 0.72%, that is 2417 units. Everyone clear? Hello, you're following, no? Earlier German was buying 2,400 units. Now he's saying 0.72% more I will buy, and that comes to 2417 units. Any doubts? So therefore, look at the screen. Can I say your actual rupee profit, which you had calculated, actual, now I'm not going to notional, I'm talking actual rupee profit that you had calculated. Do you realize rates and all will remain same? It is just that now your customer is not going to be buying only 2,400 units from you. Your customer will be buying 2,417. So you have to only change that 2,400 to 2,417. Everything else remains same. Everyone clear? So what I will do is I will write here okay, tell me where things will change. Therefore actual rupee profit will be 2417 units. Everything else remains same. Please give me the number. 7,25,100. Everyone clear? 7,25,100. So do you realize loss due to operating? Now operating means, can I say, this is not something to do with only currency fluctuation. It is also about your business. Your customer is asking more units because for them it became cheap and all that. You're understanding, no? So considering all that, 18 lakh 72 was your original. What 18 lakh 72 original, you understood, na? The part A, notional one. And here instead of 720, I'll take 7 lakh 25,100, and this number comes to 11 lakh 46,900. Everyone clear? 11 lakh 46,900. Now I'll tell you, I have a problem mathematically in this last calculation. Students, my problem is, do you realize that when I was selling 2,400 units, do you realize fixed cost was 1,000 rupees per unit? So 2,400 into 1,000, meaning 24 lakh rupees must be the fixed cost. But now, can I say, according to this solution of ICAI, it appears that 24 lakh 17,000 became the fixed cost. Come on, think what I'm trying to say. Now, fixed cost is supposed to remain fixed, no? So what I see here recently, 2021 module, they updated and they wrote one note. Alternatively, you can assume fixed cost to be fixed. No, I'm not joking, huh? Really. It is still there in the module. You can check later. Alternatively, we can assume fixed cost to be fixed, and therefore solution changes as follows. So they have given a revised solution also. They have kept this, but they have given a revised. Now that they have given a revised, I don't want to give you this. You're understanding now? We will change this. I hope you're understanding. So what I will do is I'll remove this 1,000 from here, and I will take outside fixed cost as 2,400 units into 1,000. Are you all able to understand? The fixed cost I'm taking separately. Variable cost per unit will remain same only, 1,500, but the fixed cost 24 lakh. With that, can you please give me the new or the correct answer, please? 7 lakh 42,100. Correct, no? 7 lakh 42,100. This is 7 lakh 42,100. And this is 1129,900. 1129,900. All done? Clear? Okay. So a lot of writing is there. Okay. What is part B? Point B is pending, no? Okay, start please. Uh, Kindly write little fast, otherwise we'll run out of time, please. Thank you. Those who are from South India batch, would you be okay if I just extend this lecture today till 10 and complete the questions? You have any other lecture after this? No, no. Okay. Tension no give small miscellaneous questions. So those who have FR will leave by 10. No? Don't worry. You leave by 9:30 only. Understood? No? You don't have FR now. Take it. Done. Hello. Okay. Can you hear me now? Okay. Are you done copying? Okay, all right. So the audio had gone. So now I will start explaining. Ready, everyone? See, they are saying in March, this company makes the following assessment of dollar rates per British pound, meaning they are saying that in March they are sitting and estimating that on 1st September, it means around 6 months later, dollar per pound. Now, what is the meaning of these six numbers? They are saying that the rate could either be this or this or this or this or this. Are you able to understand? They are saying this could be any one of these six. And these are the probabilities given. I hope you're understanding the meaning of the word probabilities. I think many of you portfolio management, advanced capital rating is done, so you know what I'm talking about. But the majority batch here has not completed that. But in Inter CA, you had now this chapter of capital budgeting and risk analysis, summation PX concept, you know, to calculate the mean. You remember that? So do you understand that this is like X and this is like P? They are asking you, okay, what is the expected spot rate? Now, expected spot rate, they have given to you six numbers. How to find one of these? Can I say we have to calculate average of these? How to calculate average? Simple average allowed? No, they have given weights now. Hello. So what you need to do is you need to multiply by the weights, just as you did WACC, you know, KD into weight of debt, KP into weight, like that. Everything you have to multiply by weights and then add the total. Everyone clear? That is how we calculate weighted average. Basically, from statistical point of view, X bar is equal to summation PX. This concept, you know, X bar is equal to summation PX. Zoom people have heard this, no, in Inter CA? Hello? Never heard? How you cleared? Hmm? In Inter CA, you had na this chapter, capital budgeting and risk analysis, probability approach. It was all based on this only. Anyways, you will not nod your heads like in this fashion once portfolio management is over. Hmm? I hope you people agree. Portfolio management was all about this formula. Bhavani, all okay? Hmm? All right. So now in the notebooks, just check what you all have done. Hope you're understanding. We have calculated a weighted average of this and we have got it as 1.81. Everyone clear? We have got it as 1.81. Students clear? No? Kusuma understanding? No? Sure. Raghurandan following? Okay. So 1.6 into 0.15 plus 1.7 into zero point 0.2 and so on. So students, according to your judgment of probabilities, average you are expecting the spot rate to be 1 pound equal to dollar 1.81. Everyone clear in the spot market? Now they are saying that you are going to be receiving some pounds in September. Listen carefully. Huh? You are going to be receiving some pounds in September. You want to convert these pounds to dollars. Now, as you are converting these pounds to dollars, they have given to you a 6-month forward rate. Can I say if you take this 6-month forward rate, you are fixing the rate at 1.80, which means, can I say 1 pound that you will receive will convert to 1.80 dollars. But if you leave it open and you don't take a forward, can I say on an average, you could end up getting $1.81. Everyone, are you all able to understand? So the question is asking, should you go for the forward? ICEI saying no, because if you go for forward, you will end up getting 1.8. If you don't take the forward, you can on an average get 1.81. Everyone ready? I disagree with ICEI solution. Ideally, you should have gone for a forward cover only and hedged your forward, because this 1.81 is not fixed now. It could be 1.6 also in future. You're understanding? But it could be 2 also in future. That risk is there. Everyone clear? So that solution, students, please read point number 2 now that ICA has given. Please read. All done? Can we go ahead? Okay. So students, with that we complete the discussion to question number 23. Now I would want you to come to question number 41. Please come to question 41. Okay. Only read the question. Okay. It's a full on time pass question. Full on time pass. They are saying that see, following are the details of inflows and outflows. Okay. We are Indian company. Okay. We are, now look at the screen now here, everyone. We are expecting 4 crore dollar inflow. We are expecting 2 crore dollar outflow. Can I say net inflow I am expecting is 2 crore? Correct. Now, in today's rate, it is 48.01. But the forward rate is 48.82. Students, can I say I will go for forward because these are expected cash flows? And can I say the forward is favorable for us? Because do you realize there is a 0.81 extra rupee per dollar that you will get? I hope you're understanding. There is a 0.81 extra rupee per dollar that you will get. So on 2 crore dollar, 0.81 meaning 16.2 million rupees extra you will get. Everybody clear? 16.2 million rupees extra you will get compared to spot. Everyone clear? Compared to spot. Point number 1 clear. Students, point number 2, same thing. 2 crore French francs I am going to receive. 80 lakh French francs I will be paying. So net, can I say 1.2 crores? That is 12 million French francs I will be receiving. Do you realize in the forward, there is a 0.67 rupee per French franc that I will be getting extra. So on 12 million, I will be getting 8.04 million, rupees extra. Next, UK pound. 3 crore UK pound I will receive. 2 crore rupee euro UK pound I have to pay. Do you realize 10 million UK pound? That is 1 crore UK pound I will net receive, and the forward rate is favorable by 0.41. Everyone understanding time pass? No? Hello? Correct? And this is the extra rupees. Now, then suddenly one problem comes. What problem comes? In Japanese yen, I will receive 1.5 crore, but I have to pay 2.5 crore. Can I say now it's a Japanese yen payable? Now the increase in forward rate will make me lose rupees, but then the forward rate is decreasing. Can you see? The forward rate is decreasing. So do you realize in forward rate is less by 0.8? So do you realize if I am going to be suffering an outflow and if the rate is reducing, it is beneficial now for me. I hope you're understanding. It is beneficial for me. Students, clear what I'm trying to say? So when there were inflows, the forward was giving benefit in terms of higher forward. I was saying, wow, I'm getting more rupees. When there is an outflow, the forward is reducing, yen is depreciating. I'm saying very good. I'm saving some rupees. Everybody clear? As compared to spot. So then they're asking any exposure position offsetting. I'll say yes, this is an offsetting position that for me, the exposure of Japanese yen is being offset by a better forward rate. Game over. Everybody clear? I did not make the students write all this because it was very painful for me to dictate all this in the class. There's nothing, explanation is not there only. You understand, in the same time pass it is. But I would like to tell you 2023 module of ICEI. Okay, 2023 module of ICEI. They have added one line extra there in the end. Okay, wait. I have to search the question now. Wait 1 minute. I don't have control F. I need to see YouTube videos on how to do control F in this software. Anyways, yeah, 10th question, got it. 10th question. You can see this ICI 10th question, same question. So I'll take you to the solution. Okay, students, first table is same to same. Just see point number 2 now. Read carefully. You'll understand nothing great. They are just saying that when there is negative cash flow, forward rate is also going negative. So it became positive for you. When it is positive cash flow, forward rate is also going positive. That also is beneficial to you, like that. Everyone clear? So if you want, you can just take a photograph of this, or in the notebooks, you can in point 2, okay, in point 2 here, solution, no, just write there, read revised point 2 solution in ICAI module practical problem number 10. In ICAI module practical problem number 10. Okay, so students understood this question. So we complete question number, what happened now? 41. Come to question, okay, hold on. Okay. Students, question number 6 had we done earlier? Just check. Was question 6 over? It's pending. Okay, it is royal time pass. See here, they are saying calculate merchant rates if interbank rates are given and exchange margins are given. I hope you remember, on the bid rate, margin is to be subtracted. On the ask rate, margin is to be added. Can we solve it here only? Huh? So just write down here merchant rates. Merchant rates. I have taught you all this na, in the past. Hello. Merchant rates. So just write BR. 1 pound equal to rupees 66.3250 minus 0.130%. AR, 1 pound equal to rupees 66.4525 plus 0.030%. Okay, 66.2387. 88, huh? Okay, 63.2388. Sixty-seven point 66.4724. You remember, na, interbank rates are given and these exchange margins are given. Bid rate we subtract, ask rate we add. I hope you remember our history. Our past. We have discussed all this in great detail. Okay. All right, sixth question done. Now come to question number 52. Come to question number 52. Okay, now 52 is a non-ICAI question. Ideally, I ask students to cancel it only, but we will do it. Okay, so don't give it much importance. Read it carefully, please. There is one point there which is little different. Otherwise, it's very simple. बंद करना है थोड़ा ऐसा ऐसा मार और कर नहीं हो रहा है देखो कृष्णा देना जरा मेरे को वही रिमोट है ना हाँ यू वांट ठंडी लग रहा है ना बंद कर दिया चलेगा ना ठीक ओके ओके रेडी एवरीवन विल स्टार्ट ओके so a customer with whom bank entered into 3-month forward purchase hey hold on bank entered into forward purchase which means your position can I say is to sell everyone clear na your position is to sell CHF Switzerland francs at 27.25 we go to the bank in 2 months and request cancellation. Hey, can I say this is a cancellation before due date case? You are wanting to cancel 1 month before. Everyone clear? Remember na, how to cancel? Take an opposite stand 1 month forward. Everybody clear na? Take an opposite stand 1 month forward. I hope you will not make me remind you all this. Hello, you know that na? Okay. On this date, which date? 2 months. Huh? After 2 months, the spot rate is given and 1 month forward is given. Can I say to cancel? We will not go for spot rate. Now we will go for the forward rate. If it would have been cancellation on due date, then the spot rate would have been relevant. But you're canceling before due date means you need to take a forward. Everyone ready? Zoom people requesting all to please switch on the videos. Thank you. Thank you very much. Please don't do this. I will solve doubts of only those students whose videos are on. New rule, FIDI rules. Okay. Now they are asking what is the loss or gain to the customer? Point number A. Hey, now this reverse forward means same thing. Take an opposite stand and calculate. Everyone ready? So this point number A is basically your original cancellation before due date case. Can we quickly complete this, please? Let's start writing question number 52. Everyone, please. Question number 52. Write down calculation of loss slash gain to customer in case of early cancellation. In case of early cancellation. Calculation of loss gain to customer in case of early cancellation. Okay, point number A. Using reverse forward. Using reverse forward. Using reverse forward. So write down original position. Remember all this now? Original position. Tell me what is your original position? Sell CHF at the rate 27.25 at the rate rupees 27.25. You're getting the numbers from where I'm taking. Sell CHF at the rate rupees 27.25. All done. Then what will we write to cancel? Reverse, na? To cancel buy CHF. And can anyone figure out and tell me on the chat box at which rate? You also tell at which rate. 27.52. 27.52. Everybody got this number 27.52 because you are taking 1 month forward and you want to buy. You want to buy means bank will sell. 27.52 ask rate. No? 27.52 bracket AR of CHF 1 month forward. AR of CHF 1 month forward. AR of CHF 1 month forward. Done. What is the loss or gain? Loss. Therefore, loss on cancellation. Loss on cancellation will be 27.52 minus 27.25. The whole into how many CHF? 10,000 CHF. 10,000 CHF. So that is what? Rupees 2,700. Rupees 2,700. All clear? You can write here to be paid on due date. You remember, na, cancellation gain and loss happens on due date. In fact, this happens on due date. That is why in the last lecture they were charging interest na, for 1 month. You remember that? Okay, done. This is point number A. Now, students, point number B is not there in ICAI syllabus, but I will teach it to you. So keep your pens down and listen. There's some complication. Okay, please keep your pens down and listen. Everyone following, can we start please? Okay, all right. Point number B. They are saying, let's cancel this contract through money market. Now, we have never studied anything called as cancellation through money market. Are you all there? So we have to study that, but it is extra, not there in ICAI syllabus. Everyone ready? Cancellation through money market, where a money market rate for India and USA is 12 and 6%. Sorry, India and Switzerland is 10 and 6%. Are we ready? So please focus very carefully. Okay. So I'll write here cancellation using money market hedging operation. Okay. Now listen carefully. You become that customer. I am the bank. You entered into a forward contract with me. अब बाहर से आवाज आ रहा है क्या? इधर से है. Just give me 1 minute. Ready, everyone? Okay. See. Listen carefully. Don't write anything. You'll get confused otherwise. Please pay attention. Cancellation using money market hedging operation. See. You are customer, correct? Now, I'll give you a note at the start. Okay. Customer enters into 3-month forward contract with bank to sell dollar, correct? To sell dollar. Now, 2 months have passed, correct? Do you realize now in 1 month, customer has to sell dollar? Can I also use the word pay dollar to bank? End of the day, there will be a dollar outflow from your side. Hello. And bank will be giving. Everyone clear now? Bank will be giving. Hey, hello. You're everyone following? Okay. So now I'll write step 1. Ready? Step 1 is, if you remember, identify. As a customer, we have a foreign currency payable of CH. Oh, I'm sorry, it's not dollar, no, it is CHF, correct? We have a foreign currency payable of CHF 10,000. Can I say in 1 month? Come on, everyone, in 1 month. Whom is it payable to? Not to Donald Trump or anyone. You have to pay it to bank. Huh? Hello, everyone clear? Because you are into a contract now, you have to honor the contract. Correct? Okay. Now, step 2. Anyone remembers? Very good. To hedge, create a foreign currency receivable of CHF 10,000 in 1 month. Everyone remembers this? Okay. Step 3. Okay. You want to create a foreign currency receivable of CHF 10,000 in 1 month. For that, you will have to deposit something in Switzerland today. Are you able to understand? And we will deposit the present value of this 10,000. I hope you all remember all this discussion. So I'll write here, deposit, or basically invest. Present value of CHF 10,000 in Switzerland today, correct? For 1 month, correct? For 1 month. Now, how do we calculate it? Present value is equal to CHF 10,000 divided by 1 plus, what is Switzerland rate? 6%. So I'll write here 0.06 into 6 by 12. So that is basically how much percent? For 0.5% for 1 month. So please do 10,000 divided by 1.005. 10,000 divided by 1.005, and that comes to 9,950. 0.25 I'll do 9950.25. All done. 9950.25. कृष्णा तेरे को नहीं आ रहा है? $1 month. Sorry, my bad. It is 6% per annum, and we have to calculate for 1 month. Now 1 month is I by mistake wrote 6 months, but I think 0.5% is the right number. 0.5% is the right number. So did you get 9950.25 CHF? Okay. What is this CHF? Listen, I'll keep you in the story. Listen carefully. 9950 I will invest in Bank of Switzerland, Swiss bank. 9950 CHF I will invest in Swiss bank. In 1 month, it will grow to 10,000 CHF. I will take that 10,000 CHF and give it to the bank. And can I say contract over? Everybody clear? I will give it to the bank and contract over. But to deposit this 9950 CHF, I need to buy this CHF today. I hope you're understanding. I need to buy this CHF today. So I'll write here step 4, convert was the word. So I'll write here to deposit CHF 9950.25. We need to buy CHF today. Now, can you please see this? Tell me the spot rate, please. What is the spot rate? 1 CHF is equal to 27. They have given bid and ask both. Tell me quickly. 27.35. Next, 27.3 and 27.35. You got this? Of this, what is the relevant rate? Which is the relevant rate? You want to buy CHF. Bank will therefore sell CHF. Relevant rate will be ask rate of CHF. Everyone understands this? Is it going above your head? No, no. Okay. So I'll write here relevant rate will be AR of CHF, that is 1 CHF equal to rupees 27.35. Therefore, to buy CHF 9950.25, we need to pay CHF 9950.25 into 27.35, and this comes to rupees 2,72,139. Correct? 139. 272, 139. Everybody clear? 272, 139. Okay. Again, story. You have to pay CHF to bank in 1 month. 10,000 CHF, and bank will give you rupees. You have to basically sell or pay under your original contract 10,000 CHF to bank. To hedge, I am going to create a 10,000 receivable. Correct? To create a 10,000 receivable, today I had to deposit 9950 CHF in Swiss bank. But to deposit 9950 CHF in Swiss bank, I need to buy 9950 CHF today. To buy 9950 CHF today, I will require 2,72,000 rupees today, which according to this entire operation, I will borrow in India. Everybody remembers, I will borrow in India. Step number 5, I will borrow this rupees in India. Everyone clear, no? So I'll write here, step 5, borrow rupees 272,139 in India today. What is the Indian interest rate? No, 12%. At the rate 12% per annum for 1 month. Everybody clear? At the rate 12% per annum for 1 month. So the maturity value will be 272,139 into 1 plus 0.12 into 1 by 12. Basically add 1% to it. Krishna, सिर्फ 1% ऐड करने का. Okay, so 272 139 and add 1%. Tell me how much are you getting? 274 860. Everybody getting it? 274 860. This is the rupee that will be payable. Everyone clear? Okay, now things are going to take a small twist here. Now I go to on due date. Everyone ready? On due date. Students, on due date, now I will just write some steps, see if it makes sense. On due date, we will realize maturity proceeds. Madhya Pradesh, remember, realize maturity proceeds of CHF investment. And I hope you realize the maturity proceeds will be CHF 10,000. I don't need to do 9950 into 1 plus 06, 1.06 into 1, but I know now it's going to mature at 10,000 only. Everyone ready? So I will receive 10,000 CHF from my CHF Swiss bank. Can you use your intelligence and tell me what should I do with this CHF? Not payback, no. I'll honor the contract. Are you able to understand? I'll honor the contract. Now my contract was there. So I will write here execute forward contract by selling CHF 10,000 to bank and receiving, can I say you will receive rupees na, hello, and receiving HF 10,000. What is your original contracted rate? 27.25. 27.25. Can I say rupees 2,72,500 is what you will receive? Come on, everyone clear? 272,500 rupees you will receive. Anyone can figure out what to do with these rupees. Now I will repay the loan. Everybody clear na? Now I will repay the loan. So here I'll write step 8, repay rupee loan. And I hope you realize that rupee loan has grown to rupees 2,74,860. Everyone clear? 274,860. Do you realize therefore loss will be 274,860 minus 272,500, and that comes to rupees 2,360. Everyone clear? So if I would have normally gone and just taken a reverse forward and completely cancelled the contract, can I say I would have had to suffer a loss of 2,700? Hello. But by going through this entire route, I am reducing my loss by to only 2,360. Understood? Everybody clear? 2,360. Done. This is not there in ICA. ICA asks you to cancel directly by taking forward, reverse forward. Here there is something new. All done. Okay. Now step 8, option B completed. By the way, don't be shocked. Oh, sir, at the end we were supposed to get gain and all. No, no. These are not some arbitrage steps. Huh? Hello. These are money market instrument. Everyone, we are not doing arbitrage. That is the IRPT arbitrage was different steps only. I hope you're understanding. That is something else only. That was buy in foreign, invest in home, borrow in foreign, invest in home, or borrow in home, invest in foreign. That was a different kind of calculation. We are not doing that here. Everyone ready? Okay. Now comes point number. So in point number A, loss is 2,700. Point number B, loss is 2,360. You got clarity? Point number C, bank is saying you want to cancel. Okay, cancel. Just pay penalty 2,000. You understood? Didn't understand. Just pay penalty 2,000. Go home. Understood now? So in that, can I say option 3? Option, what am I writing here? Option, point number C. Correct. Point number C is penalty. Okay. Now penalty option, can I say the loss is rupees 2,000. What to do here? Nothing else is to be done here. Everyone clear? Now one student once told me that, sir, what if we can think like this? And that student was right. When are you paying the penalty? Because you see, all above calculations are as on third month calculations. What if the bank is making you pay this penalty on the second month only? Because you are going on the second month, no, sir, to cancel. Are you able to understand? So if this is the second month calculation, I hope you're getting it. I need to know what is my loss at the end of third month now in order to compare everything. Everyone clear? So for that, students, can I say I will simply add 1% interest to it, because we are in India. This is happening in Indian interest rate. Indian interest rate is 12% per annum. That is 1% for 1 month. So if it is 2,000 as on end of second month, it is effectively rupees, tell me, 2020, 2020 as of end of third month. Everybody clear? Just 21% extra. Got clarity? Everyone clear? Otherwise, if you assume the 2,000 to be a penalty which you are supposed to pay at end of third month, then 2,000 is the answer. Everybody clear? Then 2,000 is the answer. So what has ICAI done? Nothing. I don't have a solution. You're understanding, no? I don't have ICAI has not given a question like this. All done? Everyone ready? Okay. Point number D. But this appears more logical, na? Because you are going on the second month, bank is telling pay immediately the penalty 2,000 and go home. So can I say for you, the 2,000 is an outflow at the end of second month, which is equivalent to 2,020 at the end of third month, like that. Done. Okay. Point number D. Point number D, they are saying if nothing is done now and spot rate after a month is 27.54, students, do you realize this becomes cancellation on due date case? I hope you're understanding. This is cancellation on due date. Here you cancelled before due date, here you are cancelling on due date. Everybody clear? So if that happens, then can I say, I'll write here cancellation on due date. Okay, cancellation on due date. Ready? Cancellation on due date. So what will you do? Very simple. I hope you remember same steps I'll follow. Okay, this what I have written here, everything will remain same. You know this duplicate what I'm doing now here, even I did for that Omega Limited. Because of that, one more thing is getting achieved. You realize it is same, only one thing is changing. You're understanding everything is, otherwise I write the whole thing. You will, some of you might also think, that everything new. It's not new, it's the same thing. Only one thing is changing. You tell me where things will change. One thing, only the cancellation rate is changing, where instead of 1 month forward we are going to be cancelling on spot rate of due date. Everybody clear? Spot rate of due date, and that rate is given to you as 27.54. In fact, they have not even mentioned AR, anything they have not mentioned. You're understanding? So I'll just write here 27.54. This is due date spot rate. Got clarity? Can you please tell me? So is there a loss? Yes, there is a loss. 27.54 minus 27.25 into 10,000, 2,900. Everybody clear? 2,900. And this is anyways on due date only. And the worst part is they did not actually ask you which option is best. They are simply asking you just calculate under all options like that. Understood the question? Everyone clear? Okay. Everything is pending, no? Point A is done. Okay. B onwards is pending. Okay. This note that you have written is basically an extra note. It is बाद में फिर नहीं, नो, नहीं मजाक कर रहा हूँ। हो गया। हो गया। 5, 4, 3, 2, 1, 0.5। डन। It's not there, no here. Where is it there? It is not there. Reverse forward is free of cost in this question. So 100 rupees, like that charges. Here is 2000 rupees penalty. It is almost equivalent to the loss. What is your question? It is about this question or general question? Ah. So then don't talk about this question. Ah. We used to ignore. But you're talking of the bank charges, no? Yes. The timing gap used to be ignored. Correct. There is no ICI precedent. Now, what can I say? Huh? When the penalty is paid, I don't know. Huh? Done, everyone? Okay. All right. So now, um, come to question number 61. Why are people saying thank you? Come to question. Today, too many questions have happened. You want break? I just now gave you break. Okay. So come to question number 61. Okay, last question for the day. And this is the last miscellaneous question. Okay. After that, I'll just talk to you for 5-10 minutes about what's going to happen, what is left, and then we will go our respective ways, part ways for the day. Okay. Please read question number 61. Nothing you will understand. Don't worry. Latest entrant in ICAI module. Latest. The question is so complicated in the way it is presented, but the answer is so moe moe. Nothing great. South India also knows now what is moe moe. It's universal language. Ready? Okay. Students, look at me. I am government of India. Namaskar. And you are drill tip company. Everyone ready? You are drill tip company. So what has happened is in India, no, I want to do some oil drilling. Okay, some drilling oil field I want to manufacture. I want to construct. So I came out with this tender offers of which company would like to buy this tender to drill to make the field ready. You won the contract. That is given in line number 1. Read please. All done. Can we go ahead? Krishna, only first line. Okay. Now, the project will require an initial investment of rupees 500 crore. Now, this line And this line we have to understand. Okay, read it carefully. The project will require an initial investment of 500 crore. Since the Indian government will pay for the amount in Indian rupee, the company is worried about exposure due exchange rate volatility. Okay. So what is happening is, dear drill dip, you want to invest in India, you have to invest in rupees. You are no longer the superpower you think you were. Huh? You have to invest in rupees. 500 crore rupees you have to do investment here. Do all the hard work. That hard work will take 1 year's time. After 1 year, get out. Go back to where you came from. The entire oil field, you should sell it back to the government. Are you all there? And when you sell it back to the government will of course give you your money also. And government is saying, we will give you how much on me rupees back? 740 crore. Everybody story clear till here. Government is giving 740 crore back. Now the government here has a bank. The name of the bank is SBI. Are you all there? And you imagine SBI and government are all in me only. Evidently, I am everything. Huh? Narcissist behavior. Okay, me. Okay, now what happens is, you drill dip, can I say, will come to India having dollars. In India only you will convert the dollars, they'll take rupees. Correct? And then afterwards, so what will be your entire modus operandi? You will come to the bank first. You will sell dollars, buy rupees, take the rupees, invest in India, construct the oil field, sell the oil field to government. From government receive 740 crore rupees, come back to me only, sell 740 crores and take your dollars back. Everyone, whatever dollars it makes. Now, can I say in this, the Indian government is facing some currency exchange risk, because there is going to be some transaction which will happen after 1 year also. Na? Hello. Today's transaction, do you realize? Hold on. When I'm saying Indian government, I'm saying SBI. Everyone clear? Na? I will be after 1 year required to take 740 crore back from you. See, as a government, I'll give you 740 crores. But as SBI, you will come back to me only with that 740 crore and buy dollars. No? So for me, there is a dollar payable to you. Everybody clear after 1 year. So the government wants to hedge this risk. Now they have spoken in a very vague language. I'll tell you what it means. Assume that the government offers a swap at a spot rate, which is $1 equal to rupees 50 in 1 year. Okay, now I'll tell you what it means. It means government is telling you $1 equal to rupees 50. You want how much rupees you want? 500 crore, na? Today you want 500 crore. That means 10 crore rupees, 10 crore dollars you have to give me. Are you able to understand? 10 crore dollar you have to give me, because 10 crore into 50 will give you 500 crore rupees. Hello. Okay. Do one thing. You can see this. This remote is SBI. Okay. This is the oil field. You American, how much rupees you have to invest in the oil field? 500 crore. You have to approach the AC remote. You're understanding? You have to approach SBI. You have to approach SBI and buy 500 crore rupees. I, the owner of SBI, I'm government. I am telling $1 equal to rupees 50. So can I say, if you want to buy 500 crore rupees, you have to pay to SBI 10 crore dollar. Everybody clear? Now, children, what is the meaning of the word swap? It means government is entering into a deal with you today regarding 10 crore dollars, that is 500 crore rupees. They are saying we will swap it. Swap means Today, you give 10 crore dollars and take 500 crore rupees. After 1 year, give back 500 crore rupees and take back your 10 crore dollar. Are you all able to understand? No exchange rate fluctuation nonsense. Game over. Are you all there? Now, can I say in that situation, you and SBI is now exposed only to 240 crore. Come on, everyone, clear. See, what will happen is today you will give 10 crore dollar to the bank and buy 500 crore rupees. You will take the 500 crore rupees from SBI, do the oil drilling work. After oil drilling is done, you will give oil drilling to government. Hello. Government will give you 740 crore rupees. Out of 740 crore rupees, take 500 crore rupees, come back to SBI. Hello. Give 500 crore rupees, take your $10 back, 10 crore dollar back. That is called a swap. Are you understanding? And now you still are left with 240 crore rupees. You will have to approach SBI only. I hope you're understanding. You will have to approach SBI only. And SBI is saying for that 240 crore, the spot rate after 1 year will be rupees 54. I hope you're understanding. The spot rate after 1 year will be 54. Got clarity? Okay. From dollar point of view, can I say your 10 crore dollar became outflow today? Hello. 10 crore dollar became inflow after 1 year. Are you all there? So from that 10 crore dollar point of view, there is no profit, no loss. Everybody clear? The profit which is actually there with you is 240 crore rupees. Come on, everyone. That 240 crore rupees, when you convert to dollar, you will divide not by 50, but you will divide by 54. Take your calculation, please. 240 divided by 54. How much dollars are you getting? 4.44 crore dollars. Do you all agree this is the only profit that you're getting? Everybody clear? This is the profit that you're getting after 1 year. Any doubts? All clear? Okay. But then they are asking you to assume that Drill Dip actually did not have 10 crore dollars at the start to give to SBI. So Drill Dip must have borrowed from Bank of America. I hope you're listening. So do you realize if Drill Dip has borrowed at the rate 8%, this 4.44 crore profit is not the final profit. From that, can I say the interest has to be subtracted? Everybody clear? The interest has to be subtracted. Hello? Correct. Principal is not going to deduct the profit. Hello, you realize now principal, the 10 crore you took from Bank of America, the 10 crore you took from SBI, take from SBI, give to Bank of America, game over. Everybody clear? Hello, look at me. You took 10 crore from Bank of America, dollars, gave 10 crore to SBI, dollars. After 1 year, SBI gave you 10 crore dollars. You took the 10 crore dollar and gave to Bank of America. The 10 crore is not going to affect. The interest on 10 crore is going to affect. Everybody clear? And how much interest you will pay on 10 crore? 8% on 10 crore. That is 0.8. Correct? So do you realize 0.8 crore if I subtract from here, what is your final profit? 3.64 crore dollar. Everybody clear? 3.64 crore dollar. Any confusion? So students, now the 3.64 that we got, no? We got 3.64 crore. They got 36.44 million. I hope you're understanding the same thing. Take your time and read it carefully. So I hope as an American, you paid 100 or you paid 10 crore dollar to SBI to get your rupees. Then when government gave you 740 crore rupees, out of that 500 crore again, you gave back and you got back your dollars. You're understanding what you gave, you got back. Apart from that, you had 240 crore dollar more. I'm sorry, 240 crore rupees more. That will get converted at 54. These many dollars you will get. And interest on US dollar loan, 8% you had to pay. I hope you got it. Now the question is asking you, do you want to opt for this option? Which option? The swap, or you don't? Now you will say, if I don't, then after 1 year, when I will give you 740 crore rupees, the entire 740 crore you will have to exchange at 54. Now I hope you're understanding. Now there is no swap option here that 500 will be exchanged original rate, 240 at new rate. No. And you are exposed now. The entire 740 crore rupees, you go to SBI at 54, they will give you dollars. Students, if that happens, then please check. Then do you realize, like these two points won't come. Only one point will come, that is sell 740 crore. Everybody clear? Only one point will come, sell 740 crore. Check please. Everything same. Everyone clear na? Everything same. But I guess you are getting less. Your by going for the swap, you would have got 36.44. Here you're getting only 29.04. So since the net receipt is higher in swap, the company should opt for the same. Everyone clear? We should go for the swap. All done. Now students, what I'm going to do now is, I'm going to draw all this into a story. You know, with all those flow charts and all, from where money is coming, where it is going, etc. And then I will write down formal solution in my language, which will be easier for you to digest. Are you all ready? Can I do this sitting now till 9:40? Because at least those who want to leave can leave. No, I'm not explaining anything. You're understanding? I'm not explaining anything. I'm just doing the writing part. And that part will be there in your recording also. You just take it and write it later whenever convenient. Okay? Otherwise, feel free to leave. Understood this question, no? Last. Acha, but one thing I want to tell you. Now, what is left in the chapter? Two concepts are left. One is called as nostro vostro accounts. Okay, that concept is left. It will take 1 hour to complete nostro vostro along with the question. And then one special case is left. One special case is left. That might take another 1.5 hour more. Which means your next 2.5 hour lecture is there, no? In that, I guess, we will be completing Forex. Everyone clear? We will be completing Forex. Now, in your textbook, there is one segment called as hedge using futures, which is question 42, 43, 44, and 45. Students, we will be tackling this in middle of derivatives chapter. Everyone clear? We can't do it now because futures and options, since it is not done for you, I hope you are understanding. I will not be able to explain right now. Okay. And regarding South India and Mumbai merger, I want to tell you, I think from the next we will be merged again is for that last lecture of Forex, which means tomorrow onwards, tomorrow 7 to, what is the time for South India? 7 to 2. That 7 to 2 lecture, we will be together only. There will be no Mumbai, I guess, tomorrow with me in AFM. So tomorrow we will be starting new chapter. Are you all ready? We'll be starting new chapter. So your mutual fund book is there, no? Other chapter is there, other part is there. There you continue. You're understanding, no? There you continue your new chapter. So I'll just figure out what chapter they want me to start, and then we will start. Okay. Now, general progression after Forex could go to derivatives. Okay, we could go to derivatives tomorrow. But for Mumbai, derivatives will happen with that May 26 batch. Na? Unka bhi pending hai na? You will be merged there. So Bangalore will go separate only. So in that, we can start with derivatives, or we could go to little lighter chapters like bond valuation and all. We'll see. We'll see tomorrow. Done? Okay. So thank you very much. You can now leave. I am now just drawing the story and all that I am doing. Okay. Thank you. Bye-bye. Who all is waiting can wait. लोग का क्या है, रुक रहे हैं, ठीक है। सो क्वेश्चन नंबर क्या है, व्हाट इज द क्वेश्चन नंबर? 61. Okay, question 61. Okay, so I am writing here story of swap. Now wait, don't write story of swap. Okay, there is government of India, there is SBI, there is Bank of America, and then there is drill dip. Okay, there is drill dip. Now, though you're all paying attention, okay, so I've got live audience, very good. So what will happen is, from Bank of America, okay, drill dip will borrow dollar 10 crore. Everybody clear? Drill dip will borrow dollar 10 crore, and I'll just write here, this is the oil mining field. Hmm? Can I say this 10 crore dollar that drill dip will borrow from Bank of America? Drill dip will sell. Everybody clear? Drill dip will sell to SBI 10 crore dollar. And can I say receive rupees 500 crore? This 500 crore drill dip will take and invest in the oil field. Everyone clear? Hello, will invest in the oil field. Now all this is happening today. You're understanding all this is happening today. After 1 year, government of India will give rupees 740 crore, correct? Government of India will give rupees 740 crore, correct? Out of that 740 crore, do you realize the drill dip will pay 500 crore to SBI, and SBI will give back dollar 10 crore. Are you all there? So this is basically the swap. I hope you got it. So this is happening after 1 year, 1 year, 1 year, and I'll just mark this. Understood now, everyone? This is basically your swap. Everyone clear? This is the swap. Rate is 50. Now, apart from that, drill dip still has how much rupees? 240 crore. Na? So that 240 crore, do you realize drill dip will give to SBI? Where else will drill dip go? Na? So that 240 crore, it will give to SBI. And can I say SBI will give how much? For 4.44 crores. Okay, so dollar 4.44 crores. Everyone clear? This is also one and this is one. You got clarity? Hello. So the swap is happening at $1 equal to rupees 50. Correct? But this transaction is happening at $1 equal to rupees 54. Is it clear? Okay. Now, if you see the dollar flow, 10 crore dollar we borrowed, 10 crore dollar we sold. 10 crore dollar we got back. Now that same dollar, do you realize we will give back to Bank of America? Dollar 10 crore. This is, can I say, happening at end of year 1. But apart from that, can I say drill dip also has to pay dollar 0.8 crore, which do you realize is the interest? Everyone clear now? It is the interest. Story clear? This is the story. So I think after writing this, you should be. I hope you get clarity about what exactly is happening when. Okay. And now I will say the answer. Point number A. Calculation of gain loss under swap. Okay, not under swap, but if company agrees for swap. Correct? Ready? And here I'll write in dollars. So I'll write particulars. I'll write dollar outflow. I'll write dollar inflow. Now I'll write few points more than what ICA has done. I'll write loan taken. $10 crore. Why I took 10 crore dollar loan? Because I want to convert it to 500 crore rupees. Then I will say dollar sold to Indian bank under swap to receive $10 crore into 50, that is rupees 500 crore. For this, do you realize your 10 crore dollar went out? Everyone clear? Then after 1 year, can I say when government gives you 740 crore rupees, you will have to, out of that, take 500 crore rupees, give it back to the bank, and you will receive dollars. So I'll write down here dollars received from Indian bank. I think these notes will give you more clarity than ICI notes. Under swap on sale of dollar, on sale of rupees 500 crore. You're understanding what is happening? Hello. Dollar received from Indian bank under swap on sale of rupees 500 crore after 1 year. Clear? And I hope you realize that considering it is swap, you will get the same 10 crore dollars back. I hope you're able to understand. Same 10 crore dollars back you will get. Done? Okay. Then what you will do? Repay dollar loan. I'm talking only principal. 10 crore. So this story, I'm trying to tell you how 10 crore came, 10 crore went, 10 crore came, 10 crore went. Everybody clear? Hello. Now we are talking about profit loss. Everyone clear? We're talking about profit loss. So apart from 500, you also have 240 more. Hello. So I'll write here. This part is there. Dollar received from Indian bank on sale of 500. I'm duplicating. I'm writing here. Dollar received from Indian bank under swap will not come. And I will say on sale of 240 crore. Everybody, are you able to understand? On sale of 240 crore. This will be 240 crore divided by 54. And that comes to an inflow of $4.44 crore. Everyone clear? And last, I will say interest paid on dollar loan, which will be $10 crore into 8%. And that is an outflow of 0.8 crore. Everyone clear? So if you take total, okay, no need to take any total. The upside now, do you realize is going to be 20.8? Very simple, 20.8 crore. And here it is going to be 24, correct? 24.44 crore. Therefore, net gain equal to rupees 4.44 crore. Is it clear to all? I'm sorry, not I'm sorry, not rupees. First of all, it is dollar, and secondly, it is. I'll write dollar everywhere. So this is. In fact, we have written upstairs, not dollar, so I can cancel this. Okay. Yes, heading dollar is written. No? Okay, tell me. So dollar, how much? 3.64 crore is your net gain. Is the story clear? ICI has got 36.4 something, but it's in millions. Done. Now I will say point number B. Okay, what is point B? Calculation of gain loss. Okay, calculation of gain loss. If company does not agree for swap. Okay, calculation of gain loss if company rejects the swap. Ready? Okay. So what I will do is the same thing I will take. I'll put it here. Take minute, hold on. Okay. Now tell me, where are things going to change? 10 crore, 10 crore, 10 crore, 10 crore will remain same. Think about it. So loan taken 10 crore. Dollar sold to Indian bank to receive rupees dollar to receive rupees 500 crores to dollar 10 crore went out. Correct? You took dollar from dollar 10 crore you took from your Bank of America, dollar 10 crore you gave to Bank of India. Correct? You got 500 crore rupees. You did the oil tilling. After that, dollar received from Indian bank on sale of straight away rupees 740 crore, and after a year, everybody, are you all understanding? Straight away after a year, straight away at 740 crore. So what we will do is here, I'll just pull this down slightly. And do you realize that this will be rupees? Hold on. Now tell me, 740 crore rupees when you sell, you will get 740 crore divided by 54. Tell me how much rupees will you get? How much dollars will you get? 13.7. Correct? So you will receive, instead of this 10 crore, you will receive dollar 13.7 crore. Everyone clear? You will receive 13.7 crore, which means now out of 740, you are not bifurcating 500 crore rupees and 240 crore rupees. 500 crore rupees at the rate 50, 240 crore at the rate 54. Like that, it is not there. Entire 740 is at the rate 54. You got 13.7. Everyone clear? Tell me, out of 13.7 crore now, what to do? First, we will repay loan. Correct? We will repay the loan. So that will remain same. Correct? We will repay the loan. 10 crore dollar goes there. Okay. Next, do you realize this part is of no use now? Because that 240 crore is already taken into consideration. So I'll delete this. Can I say interest paid on loan will definitely come? Everyone clear? Interest paid on loan will come. So this I'll paste it here. Done. And then we will get our final answers. Okay. Now let's see what answers are we getting. So 20. Hold on. This is bracket. Yeah. Tell me. 20.8 is still 20.8 only. Hello. on the outflow side. On the inflow side, it is what, 23.7. Please check inflow side 23.7. So here I am writing 23.7 crore. Can you please tell me how much is net gain? 2.9 crores. 2.9. 9, na? Let me see what ICI has got. 29.04. It's the same thing. 2.9 crore. Everyone ready? And then what will we say? We will say that the decision, since the net receipt is higher in the swap option, company should opt for the same. Everyone clear? Done? Story clear? Full clarity is there, end to end? Okay. So you want to write this down or take screenshot? You'll write it down. I am waiting here. Huh? You want to take screenshot? Okay. So those who want to take screenshot can take screenshot and leave. Those who want to write can wait back. 5, 4, 3, 2, 1. 5, 4. Hey, hold on. Wait. 5, 4, 3, 2, 1. 5, 4, 3, 2, 1. Thank you so much. Today's lecture understood. Then please give me a yes and you can start leaving. Thank you. Bye bye. Story also you want to draw right now only. Niharika, tomorrow new chapter na, then whole chapter will then be difficult. That is why. Krishna, yes. Let the chapter get over. Mutual funds I'll do. Savant. Is it done? Okay, thank you very much. Bye bye.